let's spend a little bit of time and talk about the biggest reasons why you would potentially want to structure a deal on equity. And for me, the biggest thing is because if you're going to go to the bank and the bank's going to give you a loan and they're going to loan 80%, 90%, that loan, you have to have a down payment for that loan, right? You can't actually go and borrow again the remaining 10 or 20%. So let me put that in context. If you're going to borrow, if you need $1 million total and the bank's going to give you 800,000 and you need 200,000, it has to be cash. It has to be like equity from the partners, right? So it has to be literally your 200 grand coming out of your pocket. It cannot be like, hey, grandma, can I borrow 200 grand and I'm going to sign a promissory note and we'll tie it to the property. That would be another loan. You can't have a loan and then another loan, right? You need to have loan and cash. So the biggest reason why people structure deal with equity is because they need the cash. They need the down payment. So if you're borrowing 800 grand and you need 200 grand, that either has to be your cash or you have to come up with a partner, right? They become, instead of being an investor, now they become an investor partner, right? Because you are going to give them a portion of the equity, a portion of the ownership, and now your ownership is together, right? Because you're owning this together, when they put their cash in, it's really partly from you, right? Like it's from your entity together, it's from the company. So now the company is putting in that cash. So now it is a cash down payment and not a loan towards the remaining money you need. That's the biggest reason that I see why you'd want to structure something on equity. The bigger the deal, the more cash you need for a down payment, the harder it is to potentially raise that cash or come up with it, especially if you're going to go, if you're going to go to a local bank, if you're going to do a commercial loan, if you're going to do SBA loan, you're going to need that 10 or 20% down, and you can't borrow that money, right? Like it can't be another loan. So you're going to have to come up with cash from that, and it doesn't have to be your cash. It was not my cash. It was well over $1 million that we have to put down as a down payment for this deal. And it wasn't my $1 million that I put down. It was my investor partners. I traded ownership in the company for their money so that they could put this money down on the property so that the bank could bring in the 90% of the funds so that I had the whole 100%, right? Like I had to trade a sequence of events. I had to trade part of the ownership to get the down payment. The down payment allowed the bank to fund the rest, and now we can do the deal, right? So the bigger the deal that you have to do, the easier it is to do the deal on equity. So as you're putting this together, I like to think of it in this way. Really, there's two separate companies that you have. And I mentioned this earlier in the call, but you have a real estate company on one side and you have an operations company. And it's important to distinguish the two because you are really negotiating two different deals and they don't have to be the same. So as you are going and saying, hey, Mr. or Mrs. Investor, you are bringing this money and I'm trading that money for a percentage, it could be two different percentages. So I want you to have a takeaway on this. You could have a percentage for the real estate that is different than a percentage for the operations company, right? They do not have to be together. And you should, for sure, for asset protection, have two separate companies, a real estate company, which owns the building and leases the building to the operations company, right? The risk is really on the operations side for you getting sued by, someone who falls. It's leased, a triple net lease to your other company over here. When you are going and negotiating with your potential partner and saying, hey, here's what we're looking, right? We're going to talk about an offer next. Here's the offer that I would give you, this percentage. It doesn't have to be the same. Now, I think that it's important that you reward the investor for the risk and the capital that they're putting up. If they're putting up more capital, they should have a higher reward, right? Higher risk of their money, higher reward. So their real legitimate risk is on the real estate side. And if you're doing construction or if you're building new, really there's that time period of that 6 or 12 months where they put a lot of money into this project and it's not done yet, right? There's a legitimate risk on that side. So they need to be taken care of on that real estate company side for that risk. Once the project is done and built, then there's a lot less risk. Right now, the risk is like, can I sell the beds? Can I run my company, right? But even once that's the case, you still have a finished building. It's got a license, right? Like you probably have equity in this deal. You could, if worst case scenario happened, if you died or something like that, your partner could sell it, right? Get his money back, maybe probably make a profit. So after it is built, there's a lot less risk on the real estate. There still is some, but now there is risk of like time, right? The risk of the time of building your company, of stabilizing your business, of training your staff, creating your culture, filling your beds, right? There is now a time risk for the operator. And if you are the operator, you're gonna try and schedule a win-win here, right? So you want to win when you put in all this hard work, right? And you filled the beds and you're making a profit. So I say this because if you're scheduling two different percentages, then make your win on the cash flow. Make your win on the monthly payment. You know, if you are making great money, make your win proportionately on the operations side. And maybe their win is, it doesn't have to be higher than your win on the real estate side, but it needs to be a good enough win for them because they are legitimately taking a risk, especially during that construction time on that side. So there can be two separate things, right? And I think really find a win-win in that. And that's my biggest takeaway for you here.